Let's bring in Octavio Marenzi now, Opimas CEO. Octavio, great to have you here with us again. I was reading in your notes, you mentioned that right now, you said when it comes to the markets, it's really all about the Fed monetary policy. Now, we were talking with Joyce Chang from JP Morgan in the last hour, and she said that right now the Fed is mainly focused on the strength of the labor market. She sees no movements really from the Fed until that unemployment rate hits about 4% or lower. What do you make of some of her thoughts? Do you think that the Fed is going to wait that long?
Well, I think she's right. The Fed is going to sit on its hands for some time to come and be very cautious about raising interest rates. I mean, they tried a couple of years ago when Jay Powell took over to raise interest rates, and the market did not respond favorably. And I don't think he's going to want to try and provoke that again. So I think the Fed is going to be very cautious about increasing interest rates. They're afraid they're going to crash the market. There's all sorts of companies and equities and stocks and bonds have become very, very dependent on the Fed's monetary policy. And they know if they pull that back too quickly, that will run the risk of a big correction there. So I think they very much want to prevent that and avoid that. So they are watching the labor market very, very closely. They're also watching inflation very, very closely. And these things are pushing them in opposite directions. So I would not want to be where the Fed is right now. I think they sort of really painted themselves into a very bad corner. If they increase interest rates, they're going to crash the market. If they don't, inflation runs the risk of running away from them.
But Octavio, I'm wondering, do they really run the risk of crashing the market when they've been pretty clear and transparent about when we can expect an interest rate hike? They're saying possibly not until late 22 into early 23. And if that changes, Fed Powell seems to be saying he's going to telegraph that pretty clearly. So shouldn't this market be very prepared for the eventual time when rates are going to move up?
Well, I hate to disagree with you on that point. I think they've been anything other than clear and transparent when the increases are going to come. I mean, they've been talking about increasing interest rates at some stage in the future. So I don't think it's that clear and transparent at all. I mean, they're very vague about it, I think, overall, and quite deliberately so. I know they want to sort of convey this sense of transparency and clarity in terms of the policy decisions. But I think if you really listen to what they're saying and look between the lines, it sounds like they're not really sure when or if, or they might start thinking about it at some stage in the future. They're basically talking about increasing interest rates. And that's really where we stand at the moment. So they're being, I think, deliberately unclear because they're very uncertain about where to go next.
All right, we can respectfully disagree, Octavio. That's okay. But I want to ask about tomorrow's report and what would be a report that would make Wall Street happy. And by that, I mean, if the report comes in weaker than expected, might the market actually find a reason to rally because it means that the Fed is just going to have to sit on their hands a little bit longer?
Well, I'm so glad we found common ground now that we can agree on it. I think that's exactly right. So the market actually wants a bad jobs report, perverse as that sounds. They want the job numbers to come in weak, so the Fed has a reason to continue its monetary policy and maybe even lower interest rates further. So that is really what the market is hoping for. The market is hoping for a bad jobs report so the Fed can come to the rescue and say, we're not going to increase interest rates, we're going to keep them ultra low, we're going to continue with this very, very loose monetary policy. And that's really what's driving markets more than anything else. So yeah, I agree with you 100% on that. It's if the job markets comes in too good, the Fed will look to increase interest rates, the 10-year yield will shoot up and markets will suffer as a result. So it's all about that at this stage.
So then let's just consider that the Fed decides to get off their hands and do something and not just think about tapering, but actually start talking about tapering. Do you imagine then that the markets, and some folks had said it had already happened, but do you think that the markets are going to throw a taper tantrum then?
I think they definitely will if they think it's serious this time. So yeah, the Fed is very keen on not letting inflation numbers go up, and they know that they can talk those down to a certain extent. So if they say, well, we will increase interest rates in the future and bring inflation under control should it get out of control, they're sort of talking the numbers down or trying to talk the numbers down. And that's, I think, the game they're engaged in at the moment. So yes, talking about it, but if they actually do start talking about it, then I think the markets will take note. Now, we have seen the 10-year yield drift down over the course of the past few months. Back in April, it was about 1.75%, and I think today is about 1.22%. So we've seen it drift down. That will, of course, reverse. And if the interest rate reverses and starts to go up, then a lot of equity prices are going to look very, very dear and very, very high indeed. So that's really, I think, the scenario that they're trying to avoid.
And I'd love to get your take on outside the U.S. where you might see opportunity? Most of the folks you've been talking to lately seem to think Europe is looking really nice in terms of valuations. They also see some opportunities in China. We've been seeing some big sell-offs there. Where do you stand on that?
Well, I think certainly if you look at the way the markets have gone over the course of the past year, the US equity markets have, of course, been sensational. The Chinese markets, much, much less so. They've had a very rough last year. Now, the question is, have those relative valuations got out of whack, and are there opportunities now in China? I think the big concern about China at the moment is really the Chinese government getting much more involved, much more proactive in the markets and regulating much more and making life difficult for people who aren't entirely in line with their own political positions and their own policy pronouncements. So I think that's a difficult market to really judge, and I wouldn't really be get into that market. The European market, on the other hand, has also been not as impressive as the US market, but I think the fundamentals there look very good. Things are opening up again, and that's definitely a market I would have a very close look at in terms of investing. The big cloud on the horizon, though, of course, is COVID-19, and we're seeing all these new variants. We're seeing all these new lockdowns coming potentially. There's people talking about new lockdowns in France, in the UK, in other countries as well. So that's the big cloud on the horizon. It's very, very hard to estimate how risky that really is.
I'm actually glad you mentioned that, Octavio, because I wanted to quickly ask you how much you see that Delta variant right now being a risk to markets. We've seen a couple of sell-offs as we've seen concerns over the Delta variant surging.
Well, I'm not a virologist. I follow markets, so it's very hard for me to say how serious is this particular virus and how is it going to take off. But I think people are taking it very seriously. And as people take it very seriously and the government's mandate further lockdowns, that's going to have a very negative impact on the market and economies and companies. So I think the balance of the risks looks like it's in that direction, that we are going to see further lockdowns coming in the not too distant future. Now, some people are saying in the UK, we're probably going to see some sort of lockdown in September. The numbers since then have improved a bit, and in other countries too. In France, they're looking worse. So I think overall, we're looking at probably more lockdowns in specific countries coming our way in the very, very near future.
All right. Octavio Marenzi, CEO of Opimas, thanks so much for joining us as always.